Welcome to Tecnia TV. Dear learners, greetings from Dr. Jamuna, Associate Professor of Management from Tecnia Institute of Advanced Studies, Delhi. Let me introduce to you the ratios and its basic types. So first, what is ratio? Ratio is a quantitative relationship between two amounts showing the number of times one value contains or is contained with others. For example, a recipe for pancakes uses 3 cups of flour and 2 cups of milk. So, the ratio of flour and milk is 3:2. To make pancakes for a particular lot of people, we need 4 times of the quantity. So, we multiply the numbers by 4. Now, 3 into 4 is to 2 into 4. That becomes 12:8. The same that 3:2 came again. We can say it in other words that 12 cups of flour and 8 cups of milk is needed. The ratio is still the same, so the pancakes should be just as yummy. Now, let's see the types of ratio. The first ratio is current ratio. The current ratio is a liquidity ratio that measures a company's ability to pay the short-term and long-term obligations. To calculate the ratio, we have to compare current assets to current liabilities. Here, current assets include cash, accounts receivable, inventory, and other assets that are expected to be turned into cash in less than 1 year. Current liabilities include accounts, wages, tax payable, and the current portion of long-term debt. The formula for calculating a company's current ratio is current assets divided by current liabilities. So, a current ratio that is in line with the industry average or slightly higher is generally considered acceptable. A current ratio that is lower than the industry average may indicate a higher risk of distress or default. Similarly, if a company has a very high current ratio compared to their peer group, it indicates that a management may not be using their assets efficiently. The current ratio is called current because, unlike some other liquidity ratios, it incorporates all current assets and liabilities. This ratio can also be called as a working capital ratio. The second ratio is quick ratio. The quick ratio is an indicator of a company's short-term liquidity position. That means the company's ability to meet its short-term obligations with its most liquid assets. It is also called as the acid test ratio. An acid test ratio is a quick test designed to produce instant results. So, the name is given to this. Quick ratio is calculated by dividing liquid assets by current liabilities. Here, what are the liquid assets? The cash and its equivalents, marketable securities, accounts receivables can be called as liquid assets. The quick ratio is a more conservative version of another well-known liquidity metric, which is the current ratio. Though the two are similar, the quick ratio provides a more rigorous assessment of a company's ability to pay its current liabilities. It does this by eliminating all but the most liquid of current assets from consideration. Inventory is the most notable exclusion in liquid ratio because it is not as rapidly convertible to cash and is often sold on credit. But sometimes analysts include inventory in the ratio if at all it is more liquid than certain receivables. The third one is cash ratio. The cash ratio is the ratio of a company's total cash and cash equivalents to its current liabilities. The metric calculates a company's ability to repay its short-term debt. This information is useful to creditors when deciding how much debt, if any, they would be willing to extend to the asking party. The cash ratio is generally a more conservative look at a company's ability to convert its liabilities than many other liquidity ratios because other assets, including accounts receivable, are left out of the equation. The formula for the cash ratio, like the current asset and the quick ratio, uses current liabilities as a denominator in the formula. Cash ratio is equal to cash plus marketable securities divided by current liabilities. The cash ratio is most commonly used as a measure of company's liquidity. We have seen already the metric calculates a company's ability to pay current liabilities using only cash and cash equivalents on hand. If the company is forced to pay all current liabilities immediately, this metric shows the company's ability to do so without having to sell or liquidate other assets. The next is debt ratio. The debt ratio is a financial ratio that measures the extent of a company's leverage. The debt ratio is defined as the ratio of total debt to total assets. It can be expressed as a decimal or percentage. It can be interpreted as a portion of a company's assets that are financed by debt. So, the formula is debt ratio is equal to total debt divided by total assets. A debt ratio greater than 100% tells you that a company has more debt than assets. Meanwhile, a debt ratio less than 100% indicates that a company has more assets than debt. Used in conjunction with other measures of financial health, the debt ratio can help investors to determine a company's risk level. The higher the debt ratio, the more leveraged a company is, implying greater financial risk. At the same time, leverage is an important tool that companies use to grow, and many businesses find sustainable uses for debt. The fifth one is debt equity ratio. Debt equity ratio is calculated by dividing a company's total liabilities by its shareholders' equity. These numbers are available on the balance sheet of a company's financial statement. The ratio is used to evaluate a company's financial leverage. The debt equity ratio is also referred to as a risk ratio or gearing ratio. The formula for calculating the debt equity ratio is total liabilities divided by total shareholders' equity. A high debt equity ratio is often associated with high risk. It means that a company has been aggressive in financing its growth with debt. The next ratio is capitalization ratio. Capitalization ratio describes to investors the extent to which a company is using debt to fund its business and its expansion plans. These are the indicators that measure the portion of debt in a company's capital structure. Capitalization ratios include the debt equity ratio, long-term debt to capitalization ratio, and total debt to capitalization ratio. The formula for capitalization ratio is total debt divided by total debt plus shareholders' equity. While a high capitalization ratio can increase the return on equity because of the tax shield of debt, a higher portion of debt increases the risk of bankruptcy for a company. Next one is dividend payout ratio. The dividend payout ratio provides an indication of how much money a company is returning to shareholders versus how much it is keeping on hand to reinvest in growth, pay off debt, or add to cash reserves. The dividend payout ratio can be calculated as the yearly dividend per share divided by earnings per share, or equivalently the dividends divided by net income. The payout ratio is also useful for assessing a dividend's sustainability. Companies are extremely reluctant to cut dividends since it can drive the stock price down and reflect poorly on management's abilities. If a company's payout ratio is over 100%, it is returning more money to shareholders than it is earning and will probably be forced to lower the dividends. Stop paying it altogether. That result is not inevitable. However, a company endures a bad year without suspending payouts, and it is often in their interest to do so. It is therefore important to consider future earnings expectations and calculate a forward-looking payout ratio to contextualize the backward-looking one. Hope the ratios are clear to you. We will meet later with some calculation part. To watch more videos, subscribe to Tecnia TV. Thank you, viewers.